Hi, hi candidate. Welcome to another session of manifested online classes. In this session, I want us to continue with the topic of earnings per share. In our first session on this topic, we defined what is earnings per share. We looked on the importances or basically the benefit of earnings per share, and also we were able to define some of the terms you need to know and basically which you'll come across during the computation of earnings per share. In this session, I want us to continue and look on the various types of earnings per share to be computed and disclosed by the listed companies. Remember, in our first session, we said that listed companies are expected or basically are required to compute and disclose earnings per share or two types of earnings per share in accordance with the International Accounting Standard number 33. So therefore, we have two types of earnings per share to be computed and also disclosed by listed companies. So we can say that there are two types of EPS to be computed and disclosed by listed companies. So which are they? Number one, we have the basic earnings per share. Basic earnings per share abbreviated as BEPS. And number two, we have the diluted earnings per share abbreviated as DEPS. So therefore, what we're going to do as far as this topic is concerned, we're going to look on how these two types of earnings per share are computed. So let's start with the first one, and that is the basic earnings per share. Basic earnings per share, BEPS. BEPS. Now this is the earnings per share which is computed based on the profit for the current financial year and also based on the shares issued and fully paid as at the end of the year. It is computed based on the profit for the year and also based on the number of ordinary shares issued and fully paid at the end of the year. So how do we compute these earnings per share? The basic earnings per share is computed by taking the profit, which is also known as earnings. Earnings attributable to ordinary shareholders. And this profit attributable to ordinary shareholders, this one is abbreviated as PATOS. And then we divide that with the weighted average number of ordinary shares, of which this one equally is abbreviated as what? As WANOS. WANOS for weighted average number of ordinary shares. PATOS is for profit attributable to ordinary shareholders. So therefore, that's how we compute the basic earnings per share. I want us to look on how we determine these two items, the PATOS and also WANOS, and we start by looking on how we determine the PATOS, that is the profit attributable to ordinary shareholders, and we can say that it is computed as follows. So in this case, to compute the profit attributable to ordinary shareholders, we take the profit after tax reported by the company or reported by the group. The profit after tax is also known as the net income. This is also known as the profit for the year. To this, we less the preference dividends. Dividend for the current year only. Preference dividend for current year only. And then when computing the earnings per share for a group of companies, to this particular profit for the year, we also less the profit attributable to non-controlling interest. Profits attributable to non-controlling interest. But remember, in this case, I've said that this will only apply whereby we are computing the earnings per share for a group of companies. So if you're computing the earnings per share for a single company, definitely will not be having that profit attributable to non-controlling interest. So and then what we have down here is the profit attributable to ordinary shareholders. But equally, as far as these particular dividends are concerned here, as far as the preference dividends are concerned, there are points which are important for you to know. And I think I've already mentioned one of it, that the preference dividends which we raise from that profit for the year should only be the preference dividend for the current year. If the company in a certain financial year happen to have paid dividends of 2 or more financial year, you don't less the dividends for all the dividends which were paid, but you only less the dividends, the preference dividends for that financial year. But equally, here we can have some additional points to be noted. As far as the computation of preference dividends are concerned. Number one, preference dividends on redeemable preference shares are not deducted from profit after tax. Preference dividends on preference shares which are redeemable, we don't deduct them here from the profit afterward tax. So the reason being is that, or the reason behind that is that the preference dividends on preference shares which are redeemable, those particular dividends are classified as part of the finance cost simply because these preference shares are redeemable. They are preference shares issued by the company, but they'll have to be redeemed after a given period of time. These preference shares which are redeemable to the company, this is like a debt capital. In fact, when the company is preparing the statement of financial position, redeemable preference shares are classified as part of non-current liabilities. So therefore, their dividends, we are saying they are classified as part of the finance cost. Finance cost is an expense. In arriving at this particular profit for the year, finance cost will have been deducted. That's why we are saying don't less preference dividends here in relation to preference shares which are redeemable. And if preference shares are redeemable, the examiner will give you some information about that. So number two is that if preference shares issued by the company are cumulative, then always we less their dividends from the profit from tax, whether or not those particular dividends were paid or what proposed. So cumulative preference shares, we can say dividends on these shares are deducted from profit after tax, whether or not paid all proposed. So I think those are some of the key important points which are important for you to know as far as the computation of this profit attributable to ordinary shareholders is concerned. So let's look on how we compute the one-knows weighted average number of ordinary shares. Weighted average number of ordinary shares. Now this one is computed by taking into account the number of ordinary shares which were issued and fully paid at the start of the year, and then we add the other shares which the company issued during the current year. So through that you get the weighted average number of ordinary shares. So it is computed by taking number of ordinary shares of ordinary shares outstanding at the start of the year, outstanding at the start of the year. So in this case, when talk about shares outstanding at the start, we are talking of ordinary shares issued and fully paid at the start of the year, taking ordinary shares outstanding at the start of the year, plus additional shares, shares issued in course of the current year, in course of the current year, in course of the current year. So that's how we compute now the weighted average number of ordinary shares. But now, how do we treat those particular shares which are issued during the current year? Now, first of all, the shares which the company issued during the current year, we broadly classify them into two. The shares which are issued at full market price and those shares which are issued at nil what? Consideration. So we can say that shares issued during the current year, are broadly classified into two categories, or into two, broadly classified into two. Number one, we have the shares issued at full market price, shares issued at full market price, and number two, shares issued at nil or no consideration. At nil or no consideration. So these are all, first of all, and talk about the shares issued at full market price. These are those particular shares which the company will issue during the current financial year, and they are issued at full market price. Full market price means that these shares have been issued at a price equivalent to the market price per share. The market price per share is the price at which the shares of the company are trading in the securities exchange market. And these particular shares, for the purpose of computing the weighted average number of ordinary shares, these particular shares, what we do, we weigh them on time basis. So what do you mean by weighing those particular shares on time basis? Those particular shares, in other terms, will be multiplied with the proportion of time the shares were held during that year. If the shares were issued 6 months to the end of the year, then what you do, you multiply them with the proportion of time they were held. And then on the other hand, these particular shares which are issued at nil or no consideration, these shares are not weighted on time basis. We don't multiply these particular shares with the proportion of time they were held during that year, even if those shares were issued like 1 month or 2 months to the end of the year. So basically what that means is that to compute this weighted average number of ordinary shares, always we start with the balance brought down. What is the balance brought down? These are number of ordinary shares outstanding at the start of the year, start of the year. In other terms, these are ordinary shares which were issued and fully paid at the start of the year. And then in this case, we are saying you add the other shares which were issued during the current year. The shares which were issued during the current year are the ones which we are classifying into two. Number one, we have issue at full market price. And basically we are saying that those particular shares, we take the shares which were issued and then multiply those particular shares with a proportion of time they were held during that year. If, for example, the financial year of the company start on 1st of January, and end on 31st of December, and we are told on 1st of July, the company issued 2 million ordinary shares at full market price. So when adding those particular shares to the shares issued and free paid at the start of the year, we don't add them as 2 million. But rather what we do, we take the 2 million shares, but we are saying multiply them with the proportion of time they were held. The shares were held for 6 months, 6 months out of 12. So whatever you get is now what you bring there. That's what you mean by weighing those particular shares on time basis. But on the other hand, those particular shares which are issued at nil consideration or free of charge, and a good example of this is a bonus issue. These particular shares are not weighted on time basis. So we have issue at nil consideration, and basically what we are saying is that these shares are not weighted on time basis. In other terms, you don't multiply them with the proportion of time they were held during that year. We don't multiply them with the proportion of time they were held during that year. So basically by doing that, we get something called the weighted average number of ordinary shares. So therefore, in computing the basic earnings per share, we take the PATOS, or we compute the PATOS, profits attributable to ordinary shareholders, and then we definitely divide that with what? With the weighted average number of ordinary shares. Weighted number of ordinary shares. Yes, so from there, once we proceed and look on how we treat different types of shares which are issued by the company during the current year, or basically we look on the reasons why the number of shares issued by the company at the start of the year changes. So therefore, let's look on that. So once we look on the causes of changes in number of shares, and that is specifically number of ordinary shares. So the number of ordinary shares issued by the company at the start of the year may change due to a number of reasons. Number one is due to issue of shares. That is ordinary shares at full market price. So when talk about the shares issued at full market price, these are the shares the company issued during the current year at a price equivalent to the market price. Market price is the price at which the shares of the company are trading at the securities exchange market. Now, this particular shares, there is something we have said here. That always those particular shares are supposed to be weighted, or they are supposed to be multiplied with the proportion of time they were held. So we can say that these shares are weighted on time basis. I.e. they are multiplied with the proportion of time they were held. During that year. So basically what that means is that if the company issued ordinary shares at full market price, maybe 6 months to the end of the year, what you do when computing the weighted average number of ordinary shares, you'll take those particular shares issued at full market price. You'll take the issue at full market price. If the company issued like 2 million ordinary shares, which were issued 6 months to the end of the year, multiply them with the proportion of time they were held during that year. So number 2, we have issue of bonus shares. So bonus shares, these are those particular shares which are issued to the existing shareholders of the company, but free of charge. Now, those particular shares are assumed to have been issued at the start of the year simply because these are the shares which the company will issue, but the company do not receive any additional resources. do not receive any amount of money. So the profit generated by the company during that year is generated using the same resources. And therefore, in this case, we assume that these particular shares have always been in issue. So we assume they were issued at the start of the year, and therefore, for the purpose of computing weighted average number of ordinary shares, we don't weigh them on time basis. So we can say that these shares are not weighted on time basis. These shares are not weighted on time basis. So the reason why they are not weighted on time basis is because these particular shares do not generate any additional resources, meaning that the profit generated by the company during that year, that profit is generated using the same resources. And actually, therefore, we assume that these particular shares have always been in issue, Equally, if we are given financial information about the previous financial year, we equally assume that those particular shares had been issued at the start of the previous year. Like, assuming you come across a question for earnings per share, and you're given information about 2 years, the year 2022, the year 2023, and during this particular year, maybe like 6 months to the end of the year, assuming the year is ending on 31st of December, 31st of December there, 31st of December, we may be told that on 1st July of that year, which is now 6 months to the end of the year, the company made a bonus issue. So we are saying that these particular shares are assumed to have always been in issue. In other terms, we assume that these particular shares had been issued not at the start of this year, because we are given 2 years, but at the start of 2022. So what is the implication of that particular assumption? Number one is that when computing the earnings per share, or when computing the one-offs for the year 2023, those particular shares, we don't multiply them with the proportion of time they were held during that year. We don't multiply them with 6 all over 12, because we are saying these shares are assumed now to have been issued at the start of the earlier reported period, at the start of the year 2022. So therefore, these shares in this year, we don't weigh them on time basis. And number two, bonus shares are also used to restate, to adjust the earnings per share of the previous year. So because when the earnings per share for this year was being computed, these bonus shares were not used, but we are saying we assume they were issued at the start of 2022. So therefore, what we do in that case is we need to restate, we need to adjust the earnings per share of the previous year. So how do we compute this adjusted or restated earnings per share? And that is basic earnings per share of the previous year. That is now the year 2022. So what we do, we take the PATOS, the profit attributable to ordinary shareholders for 2022, and then we divide that with one-offs. We know how to compute one-offs for 2022. But now to this particular one-offs, what we do, we add the bonus shares issued in the year 2023. Simply because we are saying these shares were not issued in this year, but we are saying they were we assume they were issued at the start of 2022. So what you do, you have to adjust. You have to restate or to compute afresh the earnings per share of the previous year. So that's how we deal with the bonus shares. So the other type of issue, number three, or the other reason why the number of shares issued at the start of the year may change is due to something called a share split. So when talk about a share split, this where the company subdivide one share into 2 or more shares of a lower par value. One share will be subdivided into 2 or more shares. For example, in this case, you can be told that the directors of the company have decided to split one share into 4 shares. Meaning that if you held one share before the split, after the split, you'll be holding how many shares? You'll be holding 4 shares. But it is obvious that the additional shares which you're going to or basically the additional shares which you are going to have as a result of the share split, like in this case, you will have 3 additional shares 3 additional shares, these particular shares you don't pay for. You don't pay for these particular additional shares. In other terms, you can say these are like additional shares which will be issued to you free of charge as a result of what? The share split. The share split. And therefore, the additional shares which are issued by the company as a result of the share split, they are treated as an equivalent of the bonus shares. So we can say that the additional shares issued as a result of the split, shares issued as a result of a share split, as a result of share split, are treated as an equivalent, equivalent of bonus shares. Are treated as an equivalent of bonus shares. So if they are treated as an equivalent of bonus shares, it means that these particular additional shares issued as a result of the share split during the current year in computing the weighted average number of ordinary shares, those shares we don't weigh them on time basis. And number two, we also have to use them to restate or to adjust the earnings per share of the previous financial year, of the previous financial year. And then from there we have shares, or the other reason why the number of shares issued at the start of the year may change. We have shares issued on conversion of convertible securities. On conversion of convertible securities. Conversion of convertible securities. When talk about the convertible securities, these are securities issued by the company like debentures, like bonds, and which are convertible, meaning that they can be converted into ordinary shares of what? Of the company. Once the company has issued ordinary shares, as a result of the holder of such securities converting them into ordinary shares, then the ordinary shares issued are treated as an equivalent of the shares issued at full market price. So therefore we can say that these shares are treated as an equivalent of issue at full market price. Issue at full market price, meaning that the shares which are issued on conversion of convertible securities, for the purpose of computing the weighted average number of ordinary shares, what we do is that we multiply them with the proportion of time those particular shares were held during the current year. Yes, number five, we have shares issued as a payment of purchase consideration, payment of purchase consideration. So these are the shares now which will be issued by the company under something called a share-based payment. So the company, for example, has acquired a subsidiary. The company has bought some goods. The company has been provided with some services, and the company will want to pay for those good services through by issuing its own shares. So the ordinary shares which are issued here on conversion, then equally they are treated as shares issued at full market price. So mean that those particular shares will be weighted on time basis. So we say that they are weighted on time basis. They are weighted on time basis. In other terms, these particular shares will be multiplied with the proportion of time they were held during that year. And here we consider now these particular shares not from the date they were actually issued, but from the date the shares were supposed to be issued. For instance, if a company like a parent company acquires a subsidiary, the parent company can pay the purchase consideration on acquiring this particular subsidiary through issuing its own shares. So we assume that the parent company acquired the subsidiary on 1st of January. That is the date of acquisition, which is abbreviated as DOA. But the shares which were to be issued to pay the purchase consideration, maybe they were issued on 1st of March. So in this case, we are saying that these particular shares are taken into account from the date of acquisition, because that is the date when the shares were supposed to be issued. So that is for the purpose of determining the proportion of time you are going to use in weighing those particular shares. Then number 6, we have shares issued on exercise. Shares issued on exercise of a stock option. Shares issued on exercise of a stock option. So first of all, what is a stock option? A stock option, basically this is a privilege, or in other terms, it is a right which is given to the employees of the company to buy the company shares in future at a price which is below the market price. So once the employees have been given such an option or such a right, and they have exercised that right, it means that they have bought the shares of the company, but at a price below the market price. So maybe first of all, we can say a stock option, which is also known as a share option. A share option is a privilege. To company employees. To do what? To buy company shares at a price below market price. At a price below market price, or basically at a price below the fair value. Now, anytime the company issues shares at a price which is below the market price, then it is assumed that some of the shares were issued at full market price, whereas other shares were issued at nil consideration. So we can say some of the shares are assumed to be issued at full market price, and others at nil consideration, Nil consideration basically means that these shares are issued as bonus shares. Bonus shares are those particular shares which will be issued free of charge. And therefore, anytime the shares have been issued to the employees of the company as a result of exercising the stock option, those shares, we split them into two main components. We determine the shares which were issued at full market price, and also the shares which were issued at nil consideration. So let's look on how we do that particular split. So these shares issued at or in exercise of stock option, we are saying number 1, we have those particular shares issued at full market price. We can just refer to them as issue at full market price. So how do we determine these particular shares? 1, what you need to do, or basically what we do first of all, is to compute the amount received by the company. The amount received by the company will be equal to the shares which were issued to the employees of the company times the price they were to pay per share. The employees were to pay a price of how much per share? So that will give us the amount received by the company, and then divide that with the average market price during that year. So this will give you the shares issued at full market price. Then you have to recall the rule that anytime the company issues shares at full market price, the rule is that you weigh those shares on time basis. You multiply those particular shares with the proportion of time they were held during that year. If they were held for 6 months, you multiply that with 6 months out of 12. If they were held 3 months, you multiply that with 3 out of 12. And number 2, we determined the bonus element. Bonus element, these are shares which are issued free of charge. And this is a formula which we use. First of all, take the total shares issued, total shares which were issued. the shares which were issued to the employees of the company, and then deduct issue at full market price. Issue at full market price. So the shares which were issued at full market price. And the shares which were issued at full market price, we have said this one is determined by taking amount received divided with the average market price per share. And then this particular bonus element, because these are shares which are issued free of charge during the current financial year, these particular shares, we don't do what? We don't weigh them on time basis. And then number two, if you're given information about the previous financial year, you also have to restate the earnings per share of the previous year using these bonus shares or using that bonus what element. That's how we deal with the stock option specifically when computing the weighted average number of ordinary shares. Finally, I want us to look on the last concept, which is very, very common. And this is a concept which is tested in all questions for earnings per share. And that is the concept of the right issue. Now, what is a right issue? A right issue, first of all, this is the issue of additional shares to the existing shareholders of the company at a price which is below the market price. In other terms, we say that here the company issues shares to the existing shareholders of the company at a discounted price, to the market price. If the shares in the securities exchange market are trading at 20 shillings per share, the company can issue additional shares to its existing shareholders at a price of 15. So we can say that this is issue of additional shares to existing shareholders at a price below the market price. Below market price, at a price below market price, MP for market what? Price. And the concept which I've explained here regarding the stock option will also apply here. Because these particular shares are issued at a price which is below the market price, it is assumed that some of the shares are issued at full market price, whereas other shares are issued at nil what? Consideration. Therefore, those particular shares which are issued by the company during the right issue, just like what you have done in case of a stock option, those particular shares, we split them into two components, into shares issued at full market price and the bonus what? Element. But in terms of now how we split these shares here, there is a slight difference from what you have done there. So let's look on how we split these particular shares. The shares which are issued during the right issue. During the right issue, we are saying those particular shares will be split into two components. One, the issue at full market price. To compute these particular shares issued at full market price, first of all, you need to compute how much amount was received by the company from the existing shareholders. You take the shares which were issued to the existing shareholders, divide that with what? Or basically multiply that with the price which was paid per share, and then you multiply that with something called the theoretical ex-right price. Theoretical ex-right price. I'll be able to explain later on what is theoretical ex-right price, and also we look on how we compute the same, because that is a price which the examiner will not have given you, theoretical ex-right price. And then these particular shares, because they are issued at full market price, our rule remains that those particular shares, you have to multiply them with the proportion of time they were held during that year. And then number two, you determine the bonus element. Bonus element, these are shares issued free of charge. And the formula for which we have used here also applies here. So compute the total shares issued, total shares which were issued, and then minus issue at full market price. Issue at full market price. Issue at full market price. And remember, to compute the shares issued at full market price, this is the formula which we apply here. So amount received divided that with the theoretical ex-right what? Price. And these particular shares here we don't weight them on time basis, not weighted on time basis. And equally, if we are given information about the previous financial year, you also use those particular bonus shares, the bonus element, in terms of restating the earnings per share of the previous year. So I want to explain what is theoretical ex-right price here. Theoretical ex-right price. Now, theoretical ex-right price, in very simple terms, this is the expected market price per share after the right issue. The price at which the shares of the company will be trading it in the securities exchange market after the right what? Issue. So in very, very simple terms, this is the expected market price per share, expected market price per share after a right issue. After a right what? Issue. After a right issue. So, and equally I've said this is a price which the examiner will not have given you. This is something you have to compute. So we can say it is computed. It is computed as follows. It is computed as what? As follows. As follows. So in this case, what we do here to compute the theoretical ex-right price, first of all, we take into account the shares which were held before the right issue. Before the right issue, take into account the shares which were held, and then what you'll do, you multiply those shares. You multiply those shares with the market price per share before the right issue. Before the right what? Issue. So because in most of the cases you'll be told that if, for example, you held or a shareholder held like what? 10 shares before the right issue, 10 shares before the right issue, then during the right issue, such a shareholder will be issued with 2 shares. So in this case, when we talk about the shares which were held before the right issue, we are talking of the 10 shares, which a shareholder held 10 shares, but those shares were trading at a price of how much? Multiply the 2. And then you take the shares which were issued during the right issue, like in this case, there were 2. Those shares were issued at an amount of how much? Were issued at a price of how much? And that price we refer to it as exercise price, EP. So multiply the 2. And then what you do, you come and you get the total here. The total shares which will be held after the right issue. And then you get the total value here. So let's assume that here we have gotten a value of B. And here we have gotten a value of A. So to compute now the theoretical ex-right price, we take B divided by what? By A. So that will give us now the theoretical ex-right what? A price. So that is a price now which we use up there in terms of computing the shares which were issued at full market price. So I've said that this particular concept here, the concept of the right issue, is actually tested in almost all questions for earnings per share. If you go through the past papers, specifically those particular questions from this topic, you'll be able to see almost all questions are testing this particular concept of the right issue, and is because majority of the students who sit for this paper, they have a challenge when it comes to computing the theoretical ex-right price and also splitting the shares which were issued during the right issue into those 2 components, into the shares issued at full market price and also the bonus what? The bonus element. So basically that's what you need to know. Those are some of the reasons why the number of ordinary shares issued at the start of the year will change. So you have now to know how do you deal with those different types of issues, specifically when computing the earnings per what? Per share, or the basic earnings per share. Here is today's assignment. Question 1. What are the different types of earnings per share that companies may report, and how do they differ in terms of calculation and relevance to investors? 2. Discuss the significance of basic EPS and diluted EPS and explain when each type is typically used in financial reporting. 3. How does the treatment of potential ordinary shares differ from basic EPS and diluted EPS calculation, and how does this impact the interpretation of each EPS figure? The next question, number 4, what factors can lead to changes in number of ordinary shares outstanding for a company, and how does these changes affect the calculation of EPS? The other question, discuss the impact of a stock split and reverse split on the number of outstanding shares and the EPS calculation. The last question, how does events such as share repurchase, issuance of new shares, and conversion of convertible securities influence the number of ordinary shares outstanding, and what implication does this changes have for EPS? So for now, I want us to stop at that point, but once we come back in our next session, or we meet in our next session, we're going to look on an illustration question based on a past paper question regarding how to compute the basic earnings per share. So see you in the next session.
Greetings to you all and welcome back to the lesson. The subject is Advanced Financial Management. Today we are going to answer question 2 from the December 2023 sitting. In our last session, we answered question 1. Today we answer question 2. Question 2 is in 2 parts, A and B. Part A reads, Economic and Monetary Union was formulated by European leaders. On 1st January 1999, the new European currency, the euro, came into being. From that date, there was to be no change in the exchange rates of the member countries. Euro notes and coins were introduced into circulation on 1st January 2002. Dual circulation of the euro and the legacy currencies of each country continued for a short period of time. Thereafter, participating countries have only used euro notes and coins. Required, in regards to the above statements, explain 6 reasons or arguments in favor of the economic and monetary union. 6 marks. In regard to the above statements, explain 6 arguments in favor of economic and monetary union. What are the arguments in favor of the economic and monetary union? Now, the first favor or argument in favor of the economic and monetary union, number 1, is the economic stability. EMU led to economic stability, enhanced economic stability. Such a union leads to enhanced or increased economic stability. EMU has promoted stability by eliminating currency exchange rate fluctuations among the member countries, and that stability reduces uncertainty for businesses and investors, and thereby fostering confidence and encouraging long-term investment and economic growth. So EMU has led to enhanced economic stability in Europe. It has also facilitated trade and investment. EMU has facilitated trade and investment because candidates having a single currency simplifies cross-border transactions. Having a single currency reduces transaction costs and administrative burdens associated with currency exchange, and that facilitates trade and investment among the member states or countries which then leads to increased economic integration and efficiency. So that is the second reason or argument in favor of the economic and monetary union. Facilitates trade and investment. So investment flows easily among the member states because of the barriers or the burdens associated with the exchange rate. There is also what we call price transparency. Price transparency. Price transparency and competition. This is yet another argument. With a single currency, candidates, consumers can easily compare prices across different countries and thereby fostering price transparency and competition. And that encourages businesses to improve efficiency, to improve competitiveness, and also to attract customers, ultimately benefiting the consumers through what we call lower prices and better quality goods and services. So a single currency promotes price transparency and competition among the member states. 4, there is also an argument related to monetary policy. Monetary policy coordination. Monetary policy coordination. EMU allows for greater coordination of monetary policy among member states through the European Central Bank. And such coordination, candidates, enables policymakers to respond more effectively to economic challenges, to economic shocks, such as inflation or recession, thereby ensuring a more stable macroeconomic environment across the Eurozone, across Europe. Number 5, reduced currency risk. A single currency reduces what we call currency risk. By adopting the euro, candidates, member countries eliminate currency risk for businesses and individuals engaged in cross-border transactions within the Eurozone. And that reduces exposure to currency fluctuations, making it easier to plan and conduct business activities across the national borders. Then lastly, increased foreign investment. The EMU increased foreign investment. EMU can attract foreign investment by creating a large and stable economic bloc with a single currency. And therefore, foreign investors may find the Eurozone more attractive due to reduced currency risk, due to enhanced economic stability, due to increased market access, and so on. So there is the inflow of foreign investment that can contribute to economic growth and job creation within Eurozone. Within Eurozone. So these are 6 arguments in favor of economic and monetary union. Candidates were to give 6 to earn the 6 marks. The first argument is in relation to economic stability. Number 2, it facilitates trade and investment. Number 3, EMU led to or leads to what we call price transparency and competition. Number 4, monetary policy coordination. The other argument is in relation to currency risk. And lastly, foreign investment within Eurozone, 6 marks. So we answered part A. Let's move on to part B. Part B reads, Daniel Wekesa, an investment specialist, has been entrusted with 5 million by an investment club and instructed to invest the money optimally over a 1-year period. Part of the instructions are given as follows. Number 1, the funds be invested in one or more of the 3 specified projects and in the money market. Number 2, the 3 projects are not divisible and cannot be postponed. Number 3, the investment club requires a return of 14% per annum. Number 4, the following details relate to the projects and money market. So we have the information on project 1, project 2, project 3, and the money market. We have the initial outlay for each project, the forecasted rate of return for each project, and the expected standard deviation for each project. Number 5, the correlation coefficients of returns of the above combination of projects are as follows. So we have combination P1, that is project 1, and P2, project 2. Then there is combination P1 and P3, and combination P2 and P3. Then there is information between projects and market portfolio. These are correlation coefficients of returns between projects and market portfolio. We have information on the correlation coefficients of returns between projects and money market. Then lastly, we have the correlation coefficients of returns between money market and the market portfolio. Additional information: number 1, the risk-free rate of return is 12%. Number 2, expected return of the market portfolio is a weighted average return. Given below are forecasted rate of returns from a market portfolio and their profitability of occurrence in different states of nature. So we have the state of nature known as recession, average, and boom. The probabilities are 0.3, 0.4, and 0.3 respectively. The forecasted rate of return are 10%, 15%, and 20% respectively. Required: evaluate how Daniel Wekesa should invest the 5 million shillings using Roman 1, capital market line analysis in portfolio theory, and Roman 2, capital asset pricing model, 7 marks each. That is the question. I want you candidates to go through the question again on your own, then go through it another time so that you understand the question well. And the question tested the candidate's knowledge on 2 things: the capital market line and the capital asset pricing model. Now, candidates, the capital market line is a fundamental concept in finance. It is a fundamental concept in finance that illustrates the relationship between risk and return for efficient portfolios within a given market. You understand? So it's important to underline efficient portfolios. You can see here we have 3 portfolios. In note number 5, the projects are P1 and P2, P1 and P3, P2 and P3. We may also have P3 from note number 4, P3 and money market. So those are the possible combinations. Remember the instructions. The maximum investment here is 5 million. The 3 projects are not divisible and cannot be postponed. and the funds can be invested in one or more of the three specified projects in the money market. So you can see in note number 4, project 1 is 3 million, project 2 is 2 million. So that is a possible combination. In the same note, you can see project 1, which is 3 million, and project 3, which is 2 million. That gives you a total of 5 million. That is the second possible combination. Then we have project 2, which is 2 million, and the money market, which is 3 million. That's another possible project combination. And lastly, we have project 3 and money market. That's another project combination. So candidates, the capital market line illustrates the relationship between risk and return for efficient portfolios. And to make a decision, because we have to evaluate how David Wekesa should invest the 5 million. The question now is, how are we going to carry out this evaluation? Now, using the capital market line, candidates, we are required to calculate what we call alpha. Alpha. All right? We'll be guided by alpha. All right? Alpha. Now, candidates, alpha represents the additional return earned by a portfolio beyond what would be expected given its level of risk as measured by beta. And alpha, candidates, is calculated as, this is the symbol for alpha. Alpha is calculated as the difference between the expected portfolio return, portfolio return, and the minimum required return, and the minimum required portfolio return, the minimum required portfolio return. So do you understand, candidates? So alpha is the difference, and this shows the excess. Alpha represents the additional return earned by a portfolio beyond what would be expected given the level of risk as measured by beta. So we are going to calculate the alpha for each portfolio, for each combination, and the one that will register the highest alpha is the best portfolio to invest in. So alpha, in other words, candidates, indicates the portfolio ability to outperform the market or to underperform the market, which is on a risk-adjusted basis. So that's very important. That is the formula, candidates. We are going to calculate the alpha for each portfolio. So you'll have a table here, one acceptable portfolio, one column for the acceptable portfolio. Then you'll have another column for required portfolio return. The required portfolio return. Another column will be on the expected portfolio return. Then we'll have the alpha, which you have said is equal to the expected return on portfolio minus the minimum required return. So that will give us the alpha. Then based on this alpha of the different combinations, we will advise what project to invest in, what portfolio to invest in, what the right combination of projects. For that, this is the formula. So candidates, when faced with such a question, it's important first of all to put down the formula. This is the formula. By formula, I mean the approach. This is the approach we are going to use in answering this question based on the capital market line. So anything else we are going to work out, candidates, are just what we call workings. So we are going to have our workings here. Now, candidates, going back to the question, we have in note number 4, the details related to the projects and the money market. And we've defined CML as a concept in finance that illustrates the relationship between risk and return for efficient portfolios. So in our next phase, we are going to work out or determine the efficient portfolios from the information provided in note number 4. So we're going to have here a column for asset portfolio, the possible combination. From note number 4, you can see the maximum investment is 5 million. So one possible combination is project 1 and project 2. Project 1 is 3 million, project 2 is 2 million, a total of 5 million. Another possible combination is project 1 and project 3, because 3 million plus 2 million giving us 5 million. Then the other possible combination is project 2 and money market. This money can be invested in project 2 and also the money market. Then we have another last possible combination is project 3 and the money market. So out of these possible combinations, we are going to determine efficient portfolios. Efficient portfolios are the ones that promise a higher return than what we read in note number 3, part of the instructions. Number 3, the investment club requires a return of 14% per annum. So we are going to calculate the expected return from each of these portfolios. Expected return. We are going to calculate expected return from each of these projects. And out of these returns, we'll identify the efficient portfolios. You understand, candidates? First of all, what is analyzed under the CML are efficient portfolios. An efficient portfolio is the one that promises a higher return compared to the return on investment. In note number 3 is 14%. So we are going to calculate the expected return from this portfolio, expected return from that portfolio, expected return from that portfolio, expected from that portfolio, and then we compare these returns with the 14%. The one that is less than 14% will be rejected. Then we proceed to analyze those that promise more than 14%. So what is the expected return for project 1 and project 2? Project 1 is 3 million. The forecasted, that we are reading from note number 4, the forecasted rate of return is 16%. So we are going to calculate the weight of each project. So here we have 3 over 5. Let me put it in decimals. We divide 3 divided by 5 as a decimal is 0.6. So the weight here is 0.6. 0.6 for this is 0.6 times project P1 rate of return, forecast rate of return is 16%. We add the weight for project 2, this project 2 will be 2 over 5, which is 0.4. 0.4 times the forecasted rate of return for project 2, 15%. That will give us the expected return for the portfolio. We do the same for project P1 and P3. P1 and P3. P1 and P3 is the same. That will be 0.4 times P2, 15. P2 expected return is 15% plus 0.6 times MM. MM return down there is 12%. Then moving on, candidates, to P3. P3, 2 million divided by 5 million as a percentage is 0.4, as a decimal 0.4. P3 return 22% plus 0.6 times MM return 12%. So this will be equal to the expected return for the portfolios. So that will be equal to, so the first return here, 15.6%. Convert it into percentage. Next, 18.4%. Next, 13.2%. Next, 16%. So candidates, these are the expected returns from these asset portfolios. So we need to decide, make a decision, which one are we going to analyze? And remember, we say that CML only analyzes efficient portfolios, and the benchmark is the 14%. So you can see this one here, 15.6%. This one is greater than 14%. So the decision is to accept. 18.4% is greater than 14%. Therefore, accept. 13.2% is less than 14%, reject. 16% is greater than 14%, therefore accept. So that's the first thing to do, candidates, when making capital market line analysis, is to first of all identify the efficient portfolios. So that's step number one. Then you can see, candidates, we will choose that, and that. We have three acceptable portfolios. One is P1 and P2. Then we have P2 and P3. Then P3 and money market. Three portfolios are acceptable. It is out of these three portfolios that we are going to calculate the alpha. And we have seen that alpha is equal to the expected portfolio return minus the required rate of return. We already calculated the expected portfolio return. This is the expected portfolio returns for these portfolios. So we have done this part, expected portfolio return for P1, P2, 15.6. P2, P3, 18.4. Then P3 and money market, 16%. So our next working will be to calculate the required portfolio return for each acceptable portfolio. We are going to calculate the required portfolio return. Required portfolio return. Candidates, you have read that this club, the investment club, requires a return of 14%. And a required portfolio return, candidates, the minimum required rate of return of an acceptable portfolio refers to the minimum rate of return that an investor must achieve on their investment in order to meet their financial objectives and fulfill the investment goals. It, in other words, represents the level of return necessary to satisfy an investor's needs, aspirations, and financial obligations. So we are going to calculate the required rate of return, then we will come and plug it here for each portfolio. We are going to calculate for P1 and P2, P2 and P3, P3 and MM. We plug it here, then we will calculate the alpha. So let us calculate the required rate of return. I'm going to work this out in form of a table. You can have a formula there for required rate of return, RP. Then I'll have the portfolios there. So the formula for required rate of return, candidates, is determined by adding the risk-free rate plus the premium over, this is premium, this is the premium, we divide by the standard deviation for the market, then we multiply this by the standard deviation for the portfolio. So that is the formula. Then I have here P1 and P2. That's the first portfolio. The next efficient portfolio is P1 and P. Then lastly, we have P3 and market, money market, P3 and the money market. All right. So candidates, we have the risk-free rate from the question. We have the risk-free rate. What we do not have is the standard deviation for the market and the standard deviation for the portfolio. These two variables, we need to work them out. Do you understand? So first of all, you put down the formula. This is the formula for the required portfolio return. We need these variables: the risk-free rate, the premium, the standard deviation for the portfolio, and the standard deviation for the market. Let's begin with the standard deviation. Standard deviation for the portfolio. This one. This one is calculated by so that's the formula for the standard deviation of the portfolio of P1 and P2. P1 and P2, we have the weights. These are the weights. We had already determined the weights. So we square the weight. P1 weight is 0.6, square it. Then we square the standard deviation of P1. The standard deviation P1 from the question, not number 4. P1 standard deviation is 8. So we multiply by, we square the 8 to get the variance. That is the variance of P1 plus the weight of P2. The weight of P2, 0.4, we square it. Then we get the variance of P2 is 6 squared. 6 squared. Are you following? 6 squared, this one. You square the standard deviation from the question is 6. You square it. Then we add 2 times P1 and P2. That is the weight of P1 and P2. Weight of P1 and P2 is 0.6 times 0.4. All right, you multiply the weight of P1 and P2. Then you also multiply with the correlation coefficient, the correlation coefficient of P1, P2 from note number 5, candidates. From note number 5, the correlation coefficient of P1, P2 is 0.9. 0.9. Then we multiply the standard deviation of P1 and P2. Standard deviation of P1 and P2, standard deviation of P1 and P2 is 8 times 6. 8 times 6. So that is going to give us the standard deviation for the portfolio. And that should be equal to, this should be equal to 0.6 squared times 8 squared plus 0.4 squared times 6 squared plus 2 This is 2 times 2 times 0.6 times 0.4 times 0.9 times 8 times 6. 49.536. Let me write it down here. 49.536. So candidate, this is the variance, but we are calculating the standard deviation. So we are going to get the square root. This, we have to get the square root. That is the formula, square root of the variance. So this is the variance. So what is the standard deviation? So we get, this gives me 7.04. So we've calculated the standard deviation of the portfolio P1, P2. Then we determine the portfolio of the market. We need to calculate the portfolio of the market, which is not provided within the question. Portfolio of the market. Now, to calculate the portfolio of the market, here is the formula. The portfolio of the market will be equal to the square root of the summation of T's of RM minus expected RM. We square that. So candidates, this is the formula for the standard deviation for the market. So we are going to first of all calculate the expected return, RM, which we will get the figures from note number 2. Under additional information, we have 0.3, 0.4, and 0.3. Therefore, the expected forecasted rate of returns are 10, 15, and 20 respectively. And therefore, the expected rate of return here will be 0.3 times 10 plus 0.4 times 15 plus 0.3 times 20. This will be the expected return, which is equal to 15%. Then we are going to use this expected return there, so that the market return will be equal to, now substituting within the formula, the probability, the first probability is 0.3 times the 10%, is it 10? Yes, 10%, 10% minus the expected return, 15%. Then we add. The next probability is 4%. I mean 40%, which is 0.4 into the return there is 15%. 15 minus 15 plus the last probability 0.3 into the actual, their last one is 20. It's 20 minus expected 15. So this is the summation we are adding. We add the 3, then we square. So we have to square them, square the variances, square the deviations. These are deviations. We square the deviations. Then we get the square root. So the first one here is 3.87. That is the standard deviation for the market, 3.87. 3.87. So with that, candidates, we can now calculate the required rate of return for portfolio P1, P2, because we have the risk-free rate 12% plus the return. The return here is 15%, is 15% minus 12% divide the standard deviation for the market 3.87 times what we calculated here, standard deviation for the portfolio 7.04. 7.04. So that is equal to that return. I get here 17.46. That is 17.46. That is the required rate of return for portfolio P1 and P2. We are going to do the same for P1, P3, P1, P3, P1, P3, P1, P3, P1, P3. We are going to use the same formula for standard deviation for the portfolio. So here we are going to have, this is P1, P3. So here we have P1, P3. So here we just change to 3, 3, 3. P1, P3, 3, 3, 3. All right. So what is the weight? The weight for portfolio 1 here is 0.6. 0.6. 0.6. We square it. All right. Then standard deviation for P1, standard deviation P1, looking at the information there, standard deviation P1 is 8%. We square 8% times 8%. Not 8%, but 8 squared. 8 squared plus 0.4. 0.4. The standard deviation for P3, standard deviation P3 is 10 times 10. Standard deviation P3 times 10. Okay. So we have 0.4 P3 plus 2 times these 2 times the P1, P2. So we have 0. The weight of P1 and P3, 0.6 times 0.4. 0.6 times 0. The weights of P1 and P3. Then the correlation coefficient times correlation coefficient of P1 and P3 from the question, not number 5. Correlation coefficient of between P1 and P3 is 0.5. 0.5. Correlation coefficient P1, P3, 0.5. Then times the standard deviation of P1 and P3. That is 8 times 10. 8 times 10. That is going to give us the amount that we require there. Is equal to 58.24. Get the square root. 7.63. That is the standard deviation. So you can now come here and work it out. It's 12. Is 12. Risk-free rate. 12 plus the return from the market remains the same. That is 15 over 12 minus 12 divided by dm. dm is constant. That is 3.87 times the standard deviation for the market, for the portfolio, which is 7.63. 7.63. 17.91. That is the required of return for that portfolio, 17.91%. These are percentages. Percent. 1%. Let's proceed to the last one. We want to calculate the portfolio standard deviation for the portfolio, for the last portfolio, which is P3MM. P3MM. P3MM candidates. We see the weights here. We are going to get the square root of this is P3. P3. This is M. P3 M. This is P3, correlation coefficient of P3, and M, standard deviation of P3 and M. That is what changes, but the formula basically remains the same for the standard deviation. So we get the square of, we square the weight of P3. P3 weight is 0.4. 0.4 squared. We square the one for times standard deviation for P3. Standard deviation P3 from the question, standard deviation P3 10% times 10% squared plus weight of the market MM 0.6 squared. Standard deviation of MM, not number 4, is 4. Standard deviation 4, so we have 4 squared plus 2. Weight of P3 0.4 times 0.6. This is times. Then the correlation coefficient of P3 and MM. P3 and MM is 0.15 times 0.15 times the standard deviations for P3, 10, and 4 times 10 times 4. So we can calculate now. 24.64, get the square root. It's equal to 4.96. That is the standard deviation for P3 mm. P3 mm. I come here and calculate it. P3 mm, P3 and mm. 12 risk-free rate 12% plus 15 minus 12 over market 3.87 times 4.96. 4.96. So the answer here is 15.84%. So these are the values candidates. That value, this value, and this value are the values that are required here. Those are the required portfolio returns for the three portfolios, P1 and P2. P1 and P2, 17.46, 17.46%. P2, P3, P2, this is P1 and this is P1 and P2, P1 and P3, that's correct. P1 and P3, yes, this is P1 and P3. P1 and P3, 17.91, 17.91%. Then lastly, we have 15.84%. 15.84%. So we're going to compare the two. 15, this is the expected return minus the required return. So I have here, it's negative 1.86. Next we have 18.4%, 0.4% minus 17.91%, it's positive 0.49. Then lastly we have 0.16. These are percentages. So you can see, candidates, we have analyzed. The question was, evaluate how Daniel Wekesa should invest the 5 million using the capital market line analysis in portfolio theory. So we started by saying that we ought to calculate the alphas for each portfolio. The alpha that will promise the highest return is the one to invest in, and therefore the best project, let me use that term, the best portfolio to accept using the capital market line to accept is P1, P3, P1 and P3, because it has the highest alpha. This one is negative 1.86%. This is 0.16. This is 0.49. So this is a portfolio to accept. Portfolio to accept. Then
Hello student, welcome to Manifested e-learning platform. My name is Wilson Andove and I'm your literature teacher. We are discussing written literature, and I said before you begin reading the said books, you must understand some basic terminologies which are used in written literature, essentially the said books. And that's why for the last 2 lessons we have been discussing literary terms, and today it will be a continuation of the previous lesson. So this written literature, topic is literary terms. As I've said before, literary terms just means the specific terminologies or words which are used in written literature. You should be able to understand these words for you to appreciate the set books that you're going to read. Now, in the previous lesson, we discussed an important concept we call characters and characterization. For you, student, you must understand who a character is. And we said a character is anybody, any person, or even an animal that has a role in a piece of literature. We talked about the types of characters like a protagonist, an antagonist, a villain, minor character, and major characters. Now today, we want to pick up from there and talk about conflict. For a story to move forward, you must have a disagreement or a conflict. As long as you have two people living together, even in a family setup or at place of work, where two people are, there's always a disagreement. We call that a conflict. Conflict. So, in a story, for the story, for it to move forward, we must have a disagreement. That means views which are opposing. So, we call that a conflict. We can define this as a disagreement between characters in terms of differing viewpoints on a particular issue. So when characters have different viewpoints, we call that a conflict. Now, there are types of conflicts. So we have types of conflicts. We have 4 types of conflicts. The first one is person against person. Against person. This means two characters disagreeing. So we have two characters. Can it be more? Two characters disagreeing on a matter. That is called person against person. As long as two characters or even more characters do not agree on an issue, that's called person against person. Number 2, person against self. Person against self. Now it sounds a bit contradictory. Against self. It actually, in this case, it means as a character, you have many opinions that are disturbing you. For example, you want to make a choice, but you have 2 options in life. You have 2 options. Then making that choice becomes a problem. Should you go with the option A or option B? That's a conflict, a person against self. It means different thoughts. Different thoughts and choosing the right decision becomes a challenge. It's like a dilemma. Let me give a very good example. This person who is very honest in his work, and now his boss tells him to do something that is unprofessional. that is unethical. Now, this person who is honest, who is ethical, who is straightforward, may decide not to do, actually has two options. May decide not to do what has been told by his boss. That's the first option. He will stick to his principles. But if he does that, there's a likelihood that he might face some negative consequences. He might even lose his job. The boss might reprimand him, might punish him for failing to respect maybe his orders. So in such a case, this person has two voices in his mind. One tells him what your boss has told you to do is unethical, is wrong. But the other tells him, if you don't do it, you might end up losing your job. Now, that is a conflict within you. Person against self. So this is a conflict. Conflict within a character. And in most cases, it's always of a moral nature. A moral nature. A moral nature. A very good example, a story is told of a place in Southern Africa, actually set in Southern Africa. There was a long drought spell and people were dying. So there was an oracle, a seer, it's like a god, that said, for you to end this drought, because people are almost dying, for you to end this drought, you must sacrifice a human being. You must sacrifice a human being. And not just another person, but the most beautiful lady in the community. And so, the community came together to chart the way forward. So they said they're going to choose a lady to be sacrificed. Now, that's a conflict. It's not easy for you to allow your child to be sacrificed. At the same time, if that does not happen, the whole community is going to do what? Is going to perish because of the long drought. So imagine if you're a parent of this lady, what would you do? That's a conflict within you, person against self. The third one is conflict, so not conflict, person against community. Person against community. In this case, here is a character and here is the community. The character wants to do something, yet this thing is against the community's expectations or rules or conventions. So that's a conflict. I give a very good, for example, the issue of female genital mutilation. Yes, a person who is fighting against that is called a gender activist. But the community is still so much into that cultural practice. So this person finds himself or herself in conflict with the community. Whereas he wants to eradicate FGM, female genital mutilation, the community is against that. So you find there's going to be a conflict between person and the community. So in this case, a character differs with the opinion and principles, opinion and values. Let me say opinion, values, and cultural norms of a community. So that's person against community. And lastly is person against nature. Against nature. Now we have forces of nature. So we might find a character, for something like floods. That's nature. Okay. So we may find a character who is trying to overcome forces of nature, things like floods, anything that you think is beyond your control. That's nature. So a character trying to fight off the forces of nature, such as the effects of drought in a certain region, in a given region. So this is person against nature. So student, there are 4 types of conflicts. Number 1, I've said person against person. That means person against another person, another character. Person, in this case, person means character against self. Then there's person against community. Then person against nature. When you try to fight those forces of nature that maybe are working against your downfall. So that's conflict. Now we're going to look at another concept now we call plot. Now, plot in literature means the storyline. It means the flow of events, the flow of events or actions from the beginning to the end. That is plot. The flow of event. When a story begins, can you trace, can you follow the major events or actions in that story from the beginning up to the end? That is plot. Now, plot takes some stages. Even before we look at those stages, let me give a very good example of our natural life. We're normally told a child is born. That's the first stage in life. Stage 1, a child is born. Second stage in life is that stage, for example, going to school. That's a major stage in life. The third stage can be initiation into adulthood. That's the third stage in life. The fourth stage will be maybe marriage, for those who want to marry. Okay? Then after that, can have like the working, for those who are working. Then after working, later on in life, when you have become old, you do what? You'll die. So those are the stages in life. We call that the plot of life. We know one day, from the time you are born to the time you die. Those are the stages in life. We call that plot. You can actually even draw a graph. You can draw a graph and say from the time you're born all the way to the time you are very productive in life. Then the way it works. When you are born, you are unproductive. You can draw this graph here. When you are born, you are here. Then you begin growing. As you grow, become more productive. In your prime age, you are here. At the time in your prime age, at the time you are working, you are very productive. Then as you begin to age, you begin to go down. This in terms of work output. You can't work. Begin to go down. Finally do what? You stop working. Then you die. This is the beginning point. The point where someone is born. This is the point where someone dies. So this is the plot of life. Here is education. Here is marriage, for example. Here is work. Okay? And then old age begins to set in. Old age begins to set in slowly. And then finally here you are very old. Then you die. So this can be seen as the plot of life. The flow of life. Again, the same can be applied in a story. So I'm going to draw. I'll draw it again. The same concept can be applied in a story. So a story has stages. And we're going to look at those stages. We're going to look at those stages. Stages of a plot line, of a plot. The first stage is called exposition, or some people call it point of attack. Second position is called rising action. Rising action, or complication. The third stage is called climax. Then the fourth stage is called falling action. Then lastly, we have the resolution. The resolution. So a story moves through those 5 stages. I'm going to demonstrate these 5 stages. Just like I drew that graph of life, we also have the same graph here in a story. When the story begins, at this point, when the story begins, it's called point of attack, exposition, or point of attack. When the story begins, at the beginning, that's the time we are told more about the story. This is the time we are introduced to characters and the setting of that story. It's called point of attack or exposition. Now, as the story moves on, we are going to have a conflict. Remember I talked about a conflict. We must have a what? A conflict between characters. Okay? So we have rising action here. Rising action, or what we call complication. We must have a conflict between characters for it to move forward. Now this conflict will continue building, will continue mounting. So at this point, mounting in action. I mean, the conflict will keep on growing, okay? It's building, conflict is building, is growing. Conflict is growing. Up to a point whereby it reaches what we call a climax. Climax. It will build to a point, a climax. Now this is the highest point. And after the climax, things now have to be resolved, what we call falling action. Now things have to be resolved. At this point, someone has to make a decision. Once things have to be resolved slowly, then you have a resolution here finally, and the story ends. Resolution. Now let me give an example. There is, for example, in a story where you have a child who is kidnapped. That's the story. Child is kidnapped. When the story begins, we are told there's a child who has been kidnapped. who has been kidnapped, who has been abducted. Now, parents will begin looking for this child. People begin taking action, now rising action, okay? Begin looking for this child. They will do investigation and maybe find that this child is somewhere, has been held somewhere by some people, by the abductors, kidnappers. They might even communicate with the abductors. They're called kidnappers or abductors. Even the police might be brought in, can bring the police, and they begin talking to the abductors. At the time you're having rising action, okay? It will continue mounting, building. Then now the police will decide to go and look for the kidnappers. Go and hunt them down physically. They'll go for them. Now, at that point where the police go for them, and maybe they find the abductor somewhere in a room, then there's a shootout between the police and the kidnappers. That's the climax of that story. The climax, okay? After that, now, the police, assuming that they killed the kidnappers, that's the following action. Once the kidnappers have been arrested or killed, now things will cool down. Remember, at this time, action was building. There was a lot of suspense. In fact, at this point, suspense. At this point, there was a lot of suspense. A lot of uneasiness. Okay? But once the abductors have been arrested or gunned down, then things will begin to cool down. That's falling action now. Then eventually, this child will be reconnected with the parents, will be reunited with the parents. Now that's the resolution. And then the story will do what? It will end. So student, this is the what? The normal plot of a story. Exposition, rising action, climax, falling action, and resolution. Now we're going to explain each of these terms here. So I'm going to explain each of these terms. So point of attack. Number one, said exposition. So point of attack. The beginning of a story where characters are introduced and their relationships given. That's the point of attack. Then number two, we said rising action. Rising in action or complication. So you say a conflict is introduced. Okay? This conflict mounts in action, mounts, it means grows in intensity. That's the complication. Grows in intensity. Okay? The conflict, it then forces the characters, mostly the characters, protagonist, to take action. To take action to solve the problem. That's the rising action. Number 3, climax. The highest point of a problem, of a conflict, where a decision has to be made. Has to be made. There is also heightened action. There is also heightened action and suspense. So that is the climax, and a decision has to be made. And a decision must be made. Must be made. So that the climax falling action. Things begin to slow down. The actions begin to slow down following the decision made at the climax. Then lastly, resolution. Or the problem is solved are either happy with it or not. So that's the resolution. So students, these are the stages that a story will go through. In fact, this applies most in drama. When we're doing drama, you'll see what I'm talking about. It applies mostly in drama. The next literary term that we need to look at is dialect. Now, dialect is a simple term that means that your background affects your language. For example, you have had those people from Asia. The way they speak English is not the same way we Kenyans speak English. It's not the same way the Ugandans speak English. It's not the same way the Americans speak English. We call that dialect. It means your region, your background affects how you speak that language. Even here in Kenya, people from Western Kenya speak same English, but there are some different pronunciations. People from Nyanza, Kenya, Central Kenya, Coastal Kenya, Eastern Kenya, Rift Valley, all of us speak English, but our background affects how we pronounce words. We call that dialect. So, the way we pronounce or speak a language, depending or having been affected by our areas, places of origin, places of origin. We call that dialect. I want to look at one last style, actually just two. There is flashback and foreshadow. Just two more style. Flashback. Now, the word flashback, as it suggests, flashback. You are looking back. Flash, like a camera. Flash back. So in this case, in a story, you'll find the narrator will bring in past events. Past events. For example, we find a character who is now working, has a family, and then the writer brings back this character's life when he was in primary school or when he was in high school. Now that's a flashback. When you interrupt the flow of the story to bring in a past event that is of consequence to the present event, that is flashback. When the writer of a story interrupts the flow to bring in a past event that has a consequence or a bearing on the present event. That is a flashback. And lastly, the opposite of flashback, you call it a foreshadow. And I'm going to write here. There's foreshadow. Foreshadowing or foreshadow. I've said in flashback, you bring in a past event. But a writer might want to bring into the story a future event. A future event might give you some hints of what is likely to happen in future. That's foreshadow. Like right now, you might find a character who is in high school. Then the writer gives you some hints of this character's life after high school. That is foreshadow. So the writer giving some hints about a character's future. It's like a prophecy. It's like a prophecy. We call that a foreshadow. So student, before we end the lesson, I want to give a recap of what you have learned today. We began by looking at conflict. You said a conflict is actually a disagreement can either be between characters. And there are four types of conflicts. There is person against person. That means characters disagreeing. There is person against self, whereby you have many voices in your mind that are not agreeing. And then there is person against community, whereby a character disagrees with the views held by a community. Then lastly, there is person against nature, whereby a character is fighting forces of nature. We went further and looked at now the plot, and we said our story moves in 5 stages. The first stage is what we call exposition, or the point of attack. That's the beginning of our story. Then after that, we have a conflict. that will arise, what we call rising in action or complication. That conflict will continue mounting, building to a point where we have the climax. That's the time a character has to make a decision. Then after the climax, now things will have to slow down. Then a character will finally, then we shall have now the final decision being made here, what we call the resolution. Then we have also talked about dialect, flashback, and finally foreshadowing. So student, up to that point, we shall end today's lesson. Until next time, be blessed. Thank you. Hello student, welcome to Manifested e-learning platform. My name is Wilson Andove and I'm your literature teacher. Now we have been looking at written literature, and we said before we begin reading those set books, we must understand some basic terms that are used in written literature. And that's why for the last few lessons we have been discussing terms used in literature. And in today's lesson we shall still discuss those terms, some more terms that we have not done. So written literature, and the subtopic is literary terms. Now, in the previous lesson, we looked at a major term that we call the plot outline. And I said plot means the flow of events in a story, from the time the story begins or the play begins up to the end of the play. We saw that the plot has 5 major events. The first event is what we call exposition or point of attack, whereby that marks the beginning of the story. The writer gives us information about the story. Then after the story starts, we shall have a conflict, what we call a complication. That conflict will rise, will continue to mount to a point that we call a climax. At that point, a decision will have to be made. Then the conflict is resolved. So that's how a story flows. We also looked at some other terms like flashback and foreshadow. Now in today's class, we want to look at figurative language. Figurative language, or some people call it figures of speech. Figures of speech. This is a very common term in poetry, drama, and even prose. Figurative language. It means the kind of language that has a meaning that is beyond the literal meaning. Now, language has 2 levels of meaning. We have what we call surface or literal meaning, and then you have the deeper or implied meaning. Surface or literal meaning, then you have deeper or implied meaning. For example, Alfred is a lion. Look at that statement. Alfred is a lion. The surface meaning means that this person called Alfred is an animal, a lion. Surface, what you see on the surface, called literal meaning. But Alfred is not a lion, it's not an animal. So there is a deeper meaning, an implied meaning. In this case means Alfred behaves like a lion, which means Alfred is a brave man. So this statement is called a figure of speech. You call this figurative language. I will call this a metaphor. Any language that has a meaning that is beyond what you can see is called figurative language, figurative language, or figures of speech. So we can begin by defining the term figurative language. The use of language that has a meaning that is beyond its surface meaning. In other words, there's a deeper meaning to it. There is a deeper or indirect meaning to that language. You call that figurative language. And under this, there are 4 areas, or there are 4 terms under figures of speech. Number 1 is a simile. Use of similes. Now, similes are words which compare 2 things. You might have words like as fast as a deer, as slow as a chameleon, as white as snow. Those are similes. As fast as a deer or a cheetah, as white as snow, as slow as chameleon. Now, these are similes. For it to be a simile, you must compare 2 things. For example, you have to say, let me use someone's name. Mary is as fast as a cheetah. Now, in this case, we are comparing Mary and cheetah. That's a simile. We are saying Mary runs very fast. That's the point. Very, very fast. Her teeth were as white as snow. Now, in this case, we are comparing what? 2 things. 1, teeth and snow. We are saying this person's teeth were very, very white. In other words, they were not colored in any way. So these are similes. So a simile, we can define is a statement that compares 2 things. Now, we are saying comparing. When you are comparing, those 2 things must have similarities, must have similar things. For example, we are looking at what? We are looking at the speed of this person, Mary and cheetah. Both are very fast in running. Now you are comparing 2 things or even people. So these are a simile. We use the words as or like for the comparison. So you can say Mary runs fast like a cheetah. Run fast like a cheetah. Or Mary is as fast as a cheetah. I can repeat, Mary is as fast as a cheetah. Okay, so those are similes. So that's the first figure of speech. The second figure of speech is called a metaphor. Again, a metaphor, just like a simile, it compares two things. The only difference is a metaphor gives direct comparison without using the words as or like, unlike a simile. So a metaphor gives a direct comparison between two things or people without using the words as or like. The words as or like. For example, when you talk about running, you say Mary is a cheetah. Mary is a cheetah. Now, remember I talked about the surface meaning and the deeper meaning. The surface meaning is Mary is an animal. But is Mary really an animal? No, no. We are saying Mary runs like a cheetah. We are comparing Mary with a cheetah in terms of running. Number two, maybe David is a chameleon. Now, a chameleon is known for two things. One, for moving very slowly. And number two, for changing colors. So when you say David is a chameleon, it can either mean David walks very, very slowly like a chameleon, or is someone who changes. In other words, is someone who is unpredictable. We know chameleons change their body color depending on the environment around them. So they are unpredictable. So David is someone who is untrustworthy, someone who is unpredictable. So this is a metaphor. So it means David either walks slowly or is unpredictable or is unpredictable. So that is a metaphor. The third figure of speech is called hyperbole or exaggeration. Exaggeration. To exaggerate is to make something look bigger than it is in its natural sense or form. We normally say you are blowing things out of proportion, or you are making a mountain out of a molehill. There are those statements. Blowing things out of proportion or making a mountain out of a molehill. Let me explain. We know a mole, an animal, small animal that likes making small heaps of soil. We call that a molehill. So when you make a mountain out of a molehill, then you are blowing things out of proportion. In other words, something small, you exaggerate it, you make it look so bigger than its natural form. That's exaggeration. We also call that hyperbole. It's used quite often in writing. For example, someone says, my bag. One, my bag weighs a ton. My bag weighs a ton. Now, what is a ton? A ton, as we know, is 1,000 kilograms. It's 1,000 kilograms. Very heavy. Can a bag that you carry in your hand weigh 1,000 kilograms? No. No. But you are saying this, that this bag is heavy. That's the point. This bag is heavy for this person to carry, but is not to that level of at 1 ton. So this statement is exaggerated. And what's the point of exaggeration? To create emphasis or to create humor, to make us actually see that concept. So this is hyperbole. My bag weighs a ton. Another thing, I've read the book 1,000,000 times. I've read the book 1,000,000 times. Maybe there's a book that you have read many times. But can you read a book 1,000,000 times? Really? Is it possible? It isn't. So this statement is just meant to emphasize that you have read this book many times before. Many times before. So to exaggerate or to make this point, to emphasize that you have read this book many times before, you can say, I've read the book 1,000,000 times. Okay? So this, we call this hyperbole or exaggeration. It's a very common way, it's a very common figure of speech that's used especially in prose, in narrative, to make the story sweeter or appealing to the reader. A third figure of speech, and it's very common in poetry, is what we call personification. Personification. Now, students, this word comes from the word person. A person is a human being. It's a human being, we call that a person. Now, when you give non-human beings anything that's non-human being, the quality of a human being, we call that personification. For example, you say the trees were dancing. The trees were dancing in the strong wind. The stars or the moon smiled at me as we walked, or as I walked down the river, down the road. Now, can trees dance? No, trees cannot dance. It's only human beings who can dance. So we are giving them this trait of dancing. We are saying the trees were moving in an orderly manner. You know, when you dance, you move in a systematic manner, okay? You move in a systematic manner. So we are saying the trees are moving in a systematic manner. Maybe all of them are moving towards one direction, then back. They move, then back. So they have been personified. That is, they're dancing. That's personification. The moon smiled. Can the moon smile really? Really? No. So now human being who can smile. But when you say the moon was smiling, it means the moon was shining brightly. It was a bright evening. The sky was clear. It was a bright evening. And you enjoy that kind of environment. That's why we say the moon was smiling. This gives a romantic feel. This statement gives a romantic and easy feel. There are no problems. The sky is clear. So this is what to call personification. I've just given 2 examples. There are many more examples that you will come across, especially in poetry. This was number 4, sorry. This was number 4. This was number 4. Now, these are the 4 parts. These are the 4 figures of speech that are common in poetry. The first one I said is a simile. The second is a metaphor. The third is hyperbole. Number 4 is personification. Now let us look at another literary term. And this one is called humor. Humor means that writing that makes us laugh. I think you might have seen some people reading a story somewhere, then you see them laughing on their own. Then you wonder, is this person crazy? Or someone, so if someone is watching a movie, see them laughing, reading a story, or reading a book, or even reading a newspaper. Then they're laughing on their own. Then you wonder, is this person crazy? No, it's not crazy. It's just the story is interesting. So when the story is interesting, we call that humor. Okay? So the use of words that make the story or play interesting to read, thereby eliciting laughter. Why do writers employ humor? So that you keep engaged with the story. Because if the story is not humorous, does not have humor, you'll get bored and stop reading that book. So humor is used to arrest the interest of the reader. Okay, the reader, so that you read that book to the end. That is humor. Another feature of style that I wanted to know is called satire. Some people call it parody. Now, satire, from that satirize, means to laugh at someone. To laugh at someone's weaknesses. Not physical weaknesses, character weaknesses. So it means to laugh. To laugh at someone's character weaknesses. or what we call them flows. Some people call them follies. Follies, okay? Another word is to ridicule, to mock. Mock or ridicule. To mock or ridicule a person. Now, student, let me make this very clear. We are not laughing at someone's physical weakness, no, but character. If someone is physically disabled, for example, someone is blind or is deaf or is physically handicapped, we are not laughing at them, no. That's a physical disability, okay? And you said in literature, we don't look at physical disability. We don't look at the physical part. We look at the character, personality. But you are laughing at someone's character. For example, you might find in a poem that this character who like grabbing public property. Grabbing public property. So we laugh at him. We are laughing at his behavior of grabbing, okay, of being mean, being selfish, of being corrupt. So we satirize such behavior. We satirize such behavior that are unbecoming, that are not ethical in our society. We call that satire or parody. Another term that you need to know of is idiophone. And this is a simple term. This is just a sound made by a person or an object. That's a sound. He cried. Woo-wee, woo-wee. Like when people scream, woo-wee, 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 woo-wee. Now that is an idiophone. This sound woo-wee, woo-wee is not an English word actually. It's not an English word. So we call that an idiophone. She walked. Pat, 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 pat. Pat, 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 pat. It means she was walking very fast. Quick steps, quick steps, quick steps. Huh? Pat, 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 pat. So these are idiophones, sounds made by objects. Related to this is what called onomatopoeia. Onomatopoeia. Now, onomatopoeia is actually a word that imitates sound. So this is a word. This is an English word. English word. It's an English word that imitates sound. By this I mean the sound made by an object and a word in English almost the same. For example, the word bang, this word bang. When you close the door very fast, we say we are banging the door, okay? And the sound made by the door is that of bang. The sound made by the door is that of bang. So the word bang, we say is onomatopoeia because it imitates the sound made by someone when he's closing the door. The word buzz, when bees are moving, they make sound like zzz, zzz. Now that's buzzing. That zzz sound and the word buzz are almost the same. The word hiss, when a snake moves, it makes this sound. that sound and the word, they're almost the same. So we say these words are onomatopoeic or onomatopoeia. We can look at a few more terms. The next term that we're going to look at is suspense. Now, suspense means that a writer withholds information that you want to know, then leaves you yearning for it. The writer writes something that's interesting, and then at that point, when you want to know more about that incident, he withholds, he stops at that point. Now that is suspense. So you are left guessing what happened with this person. For example, a parent who has gone out of the country and then he's coming back. Then the child goes to wait for the parent at the airport. At the airport. Then the parent says, I'm on this flight. We are lighting at 11 a.m. Then the child goes there, waits for this parent. Let's say the family goes there to wait for this parent. Then the plane touches down, that specific plane. So the family goes there to receive this parent. And then at that point, the writer stopped writing. So you are wondering, you as the reader, did the family meet this parent? See, you are left wondering when you want to know more information about this story, this incident. Then the writer stops that story. That is suspense. So the feeling of yearning, created by the writer when he withholds important information that the reader or audience wants to know. We call that suspense. The last feature that we can look at is called symbol. Now, a symbol can be something physical that means something else. It's a symbol. It can be either somebody or something physical, tangible, that stands for something else. For example, the president is a person, one person, but the president stands for unity of the whole country. So it's a symbol of national unity. He's one person, yes, but he is the country. He represents the whole country. When the president goes out of this country, he's going there as Kenya, not as one person. So it's a symbol of the country. We call that symbolism or a symbol. We even know this from our colors. We know black color. Black means what? Means two things. The color of our skin. And that's why even on the nation, if you look at our national flag, we have black color, which stands for what? Our skin, Africans. So black is a symbol of the African spirit. There is red. Red stands for the for the blood that was shed. So red means two things, either blood or danger. When you see red, even when you are crossing street lights and then the lights turn red, they're telling you there's danger, do not cross. So that red color is a symbol that there's danger, do not cross. Green means our richness, our abundance, our resources. Okay? So those colors, we call them symbols. Symbols. So a symbol can either be somebody or something tangible that represents something else. That is a symbol. A symbol is either a person or something tangible that represents something else, something big. For example, the president. The president stands for, represents the country, and stands for the unity of the entire country. That's just one symbol. If I want to challenge you, look at the meanings of colors. Meanings of colors. Those are symbols. Those are symbols. Now, student, that will mark the end of today's lesson. But before we end, we have said we are looking at figures of speech. That's what we have discussed today. And we said there are 4 figures of speech. One of them is a simile. And we say similes, we are comparing two things using the word like or as. We said you have a metaphor that compares two things without using the word like or as, the words like or as. Then there's personification, which means giving non-human beings the qualities of human beings, that you make objects appear like human beings. That's personification. Then we also talked about hyperbole.